Hello and welcome to this video for Year 11 Accounting, Unit 1, where we're going to look at income statements for service firms. This is Chapter 6 from the book VCE Accounting, Units 1 and 2, 5th edition from Neville Box. So in this video we're going to look at firstly the demands of accounting reports, because we're going to be looking at income statements, which is an example of an accounting report. We're going to have a comparison of revenues and expenses and the difference between them. And then in a comparison to last week when we looked at the statement of receipts and payments, which is a cash report, we're going to discuss the difference between cash and profit, which are two quite different things. And finally, we're going to look at how you actually prepare an income statement for a business. So firstly, let's remind ourselves of some of the qualitative characteristics and accounting principles which apply to accounting reports. So first of all, we need to remember that anything that's included in the report needs to be relevant. So it needs to be information about the business entity. It shouldn't be about any other business or about anything that's not relevant to the operation of the business. Secondly, we need to make sure that the information included in our report is reliable, and that's to say that it actually is from a genuine transaction that you have a record from a source document. Now that record from the source document might be a receipt, it might be something like a check butt, or perhaps an invoice. Thirdly, you need to make sure that the report meets the condition of comparability. So you need to be able to compare one month to the next. And the best way to do this is to make sure that your reports are laid out in exactly the same way every month. Finally, the report needs to be easy to understand and needs to be understandable for everyone who wants to look at it. So remember, we're preparing reports for business owners, not necessarily just for accountants. So everyone should be able to use them. So what is the difference between revenue and expense? So these are a couple of words you may have heard before, but they mean something quite specific in accounting. Now, revenues and expenses are used in our income statement, which is a particular type of report. So revenue is any inflow of economic benefit to the business. So this is something that has genuine value to the business. So any cash that comes in to the business would be considered revenue. But say you have a liability, like a loan to a bank, that's reduced for whatever reason, that would also be considered revenue. Also, any credit transactions, so anytime somebody buys something from you and promises to pay you for it in the future, and you have a record of that, you also know that has economic benefit to the business, and so it would be considered revenue. Now, capital from owners being put into the business would not be considered revenue. Now, the reason for this is that it doesn't increase the economic value of the business itself. Yes, the business has more money as a result of the capital going in, but the owner who is entitled to the business, they've got that, whatever money they put in, they don't have that money in their pocket anymore. Now let's look at expenses. So expense is any reduction in your assets or an increase in your liabilities. So if you pay some wages out to your employees, or if you sell some goods that you've bought, or you buy something on credit, these would be a reduction in asset or increase in a liability. So that, for example, a purchase on credit would be a liability that you have to pay in the future. So what's the difference between cash and profit? So last week we looked at the statement of receipts and payments. So let's revisit what the statement of receipts and payments is. So this is a report which shows for a business for a period of time, usually a month, the cash receipts for that business, which would come from your cash receipts journal, less your cash payments, which would come from your cash payments journal. So if you minus off your cash payments, off your cash receipts, that will equal your excess of receipts over payments. It gives you basically how much more cash you've got in your business bank account. Now, if you add to that excess whatever your bank balance was at the beginning of the month, then you'll have whatever your bank balance should be at the end of the month. So let's look at an example. Let's take a business that receives $10,000 in a month and they paid out $5,000 cash in that month. Then they would have an excess of $5,000 of receipts over payments. Let's just say, for example, they had $20,000 in their bank at the beginning of the month. Then their bank balance at the end would be $25,000 because they had $20,000 in the bank at the start and they had $5,000 more receipts than payments. So this report is purely focused on cash inflows and outflows. There's no consideration of whether their money actually has any value or any increased liabilities for the business. Now, on the other hand, the income statement, which is another report, we just simply take our revenue and minus off whatever our expenses were for the month. And that will give you whatever the profit for the period was for the business. Now, when we look at talking about profit, what we're really thinking about is the economic value of the transaction. So let's have a look what we mean by that. And the best way to do that is to look at the difference between cash and profit. So on the left-hand side here, we've got cash inflows and cash outflows and a list of the types of things that would be included. So if you receive cash from customers for services, if the owner puts cash in the business, or you borrow money from the bank, then that's all cash inflow. Cash outflow would be cash paid to suppliers, cash paid to employees, withdrawing money by the owner, or any loan repayments to the bank when you make the repayment. So all of these things would go on your statement of receipts and payments. Now, let's have a look at something. Let's look at something like a loan note. Let's say that a business borrows $20,000 from a bank. So they have $20,000 of a cash inflow. There's no cash outflow at that point. They've just got $20,000 coming in. So that looks great on the statement of receipts and payments. You've got $20,000 there, but it doesn't actually help the business much because they have a liability of $20,000 as well. The actual overall value of the business hasn't increased at all. So for an income statement, we wouldn't put that loan in because there's an equal liability. So what sort of things would we put on? For revenue, we put on anything that would actually increase the value of the business, and we really just get that through sale of goods or provision of services to customers, either by cash or on credit. So if you are selling cars, if you own a second-hand car shop and you sell a car for cash, then that's a revenue for you. You've just made that money. If somebody says that they'll pay you for the car in installments over the next 4 months, that's still revenue because it's still of economic benefit to you at that point that you know you're going to get the money for the car in the future. Now, expenses, on the other hand, are anything that you sacrifice in order to earn sales and any services used by the business. So if you owned a business like a cafe and you were selling coffees, you'd need to sacrifice coffee beans to make a coffee each time and some milk. So each time you do that, you have sacrificed some of those goods and the value of those goods in order to produce and sell that coffee. The types of services you might use, and you either pay for them at cash on credit, would be things like advertising, paying your wages, using printing for your office and things like that. So what does that look like in an income statement? In the top, we put out the name of the business. So this one example is for a cabinet maker. It shows what the title of the report is. It's an income statement for the month ended the 30th of September 2015. Now, the first section, we list all of the items of revenue for the business. So we see here this cabinet maker has sold some kitchen cupboards, some video cupboards, and some student desks. And we see over here the monetary value of those items that he sold. In the second column, there's the total of the revenue. So he sold $1,940 worth of kitchen cupboards, $800 worth of video cupboards, and $1,360 worth of student desks, for a total of $4,100. On the other hand, at the bottom of the report, he has his expenses. So firstly, there's timber that he's used to make these three items, these three types of items. So he has used $1,040 worth of timber. He also has paid $1,180 worth of wages, $250 worth of advertising, and taken out $480 worth of insurance. And you can see that's a total expense for the month of $2,950. So if you minus the expense from the revenue, you can see that he's made a total of $1,150 net profit for that month. So not included in the income statement is any capital contribution. There's no loans are included, and no drawings made by the owner, Any purchase of assets that aren't used in the preparation, or aren't sacrificed in the sale of a good, aren't listed either. And there's no GST either. So remember that GST is really just a tax which the business is holding, but is actually owned by the government. Now, assets that aren't sacrificed aren't listed because, yes, the business pays money to purchase those assets, but then the business owns that asset, which has the equivalent value of the cash used to purchase it. So that means that they have the business overall, the value of the business doesn't decrease, it's still at the same amount. So from this video, it's important that you recognise the difference between revenue and expenses and the difference between those and cash receipts and payments. Once you're clear on that and what's not included in an income statement, you'll find it very easy to prepare income statements for firms.